This video covers Chapter 12, Interest Rate Forwards and Options. It's video 2, so we're looking at the options component of this chapter. We'll look at interest rate calls and puts. We'll draw out the timelines so that we can see the timing of the payoffs. We'll calculate payoffs. We'll look at other mechanics. We'll also look at caps and floors along with caplets and floorlets, which are components of caps and floors, and then we'll do some examples. Let's start off with interest rate options. And to give you a little background on that, we could model these interest rate options using the binomial model. We could branch out with interest rates instead of stock prices on the tree. That's one way of doing it. That would give you a lot of intuition to show that the value of the option would be its ability to hedge changes in the interest rate. We could also use the Black model from the Black-Scholes model. So the Black-Scholes model was designed for stock prices, but the Black model was just Fisher Black writing this article that spells out how to use the Black-Scholes model on interest rates. So it's just called the Black model. You know, it has the look and feel of the Black-Scholes model with those inputs and very similar math. It works reasonably well, and I say reasonably well. There's one flaw with it that is important to acknowledge and recognize, is that it assumes interest rates are constant throughout the life of the option. So think about it. When we looked at stock options, we used that risk-free rate R in the model, and in there, you know, it was constant. And so we discounted everything back by that constant interest rate. Well, think about it. We're in a chapter called Interest Rate Forwards and Options. The whole context of this chapter is that interest rates are volatile, they're uncertain, there's risk associated with them. So if you have a model that's trying to capture interest rate volatility, but one of the assumptions underneath the model is that interest rates are constant, you kind of have a conflict there. Nevertheless, the model is reasonably good at approximating the value of interest rate calls and puts. We're not going to get into valuation here. We are going to look at the payoffs and the timing of the payoffs and just the basic mechanics of calls and puts on interest rates. So let me describe to you what an interest rate call option is, how it's defined. And it's defined in kind of a funny way, but I'll talk you through it so that I think it makes a little more sense. So an interest rate call option it's an option on a forward rate, right, that gives the holder the right to enter. In other words, to go long a forward rate agreement at the strike rate X. In other words, if interest rates rise, the option is in the money, just like, you know, standard call option. You're kind of bullish, but here you're bullish just on the interest rate. Okay? The holder will, you know, so if interest rates rise and it goes and LIBOR, for example, goes above the strike, the holder of the call will exercise and enter a forward rate agreement to borrow at the low rate X. Graphically, what this looks like is we got X, we got LIBOR, and we have $sign here. So we basically have payoffs that look like this. We're long interest rate call. Okay. Now, like I said, you know, the definition I just read off was kind of formal and I think a little abstract. And because it was saying, look, you have this call option and it gives you the right to flip into a forward rate agreement. Okay? Well, that's kind of a strange way of looking at it. What I like to do is look at it this way. It's basically, it's an option on an interest rate. But when you have an interest rate, you have to look at the contract size, in other words, the notional value, because you just can't, you know, you're not going to get a check for 6%. You're going to get, you need dollar signs associated with it. So you need to multiply the difference in interest rates by a notional value and adjust it for the time period, the fraction of a year that's involved. Because we're looking at basically an interest rate that's ultimately coming from a euro-dollar deposit instrument. But you don't really need to know that. What you really need to know is, look, here's the payoff. The payoff equals the notional value times the maximum of 0, or the floating, you know, the variable LIBOR rate minus that strike price X, which is, these are interest rates, adjusted for days divided by 360. See? So the way I look at it is, look, it's just an option on an interest rate, but you need to adjust it for a notional value and the number of days in a year. And so what that looks like is it's basically, you know, it's an option on a forward rate agreement. It's another way of looking at it. So a put now, put is going to look very similar to what we've seen before. And a put is going to have a payoff that's 0 when the interest rate's above the strike. And when we're below the strike, that's when things pay off on the positive side of things. And the payoff for the put, as you can imagine, is the notional value times the maximum of 0, or X. We're selling the interest rate basically with the positive sign in front of there, minus the LIBOR rate, the current LIBOR rate, whatever that is, adjusted for days divided by 360. Now, what we have to get comfortable with is this. The payoff on the option, the timing of the payoff on the option is not at the option's expiration, but it's at the end of the euro-dollar deposit period. So if this is the option's expiration, the payoff happens here. Okay? And so that's when we calculate payoffs, the payoffs are happening at this point in time. Okay, so if this was, for example, a 4x7 forward rate agreement, where what's telling you is here's the interest rate, it starts at period 4, ends at period 7, because there's a forward rate associated with it. So when you have a forward rate agreement, you have a forward rate F associated with it. And so here it is covering this time period. The option expires here, but covers this time period. The forward rate covers this time period. So the payoffs are happening at the end here at month 7. Now what we're looking at here is we're just looking at a one-off interest rate option that covers one period. But as you know, when you lend money, borrow money, you have a timeline. There is multiple times in which you're looking at various interest rates and payments throughout the life of the loan. And so, you know, having you could enter into an option that covers, you know, this forward period, an option that covers this forward period, and an option covers this forward period. But wow, that's a lot of paperwork and a lot of hassle. So the financial industry is designed to handle that using what's called caps, an interest rate cap. An interest rate cap is a series of call options, okay? A series of call options with the same strike X, okay? And that each one of these options is called a caplet. So a cap is a series of options, and the individual options are called caplets. And so what that enables you to do is to have to cover and to hedge your risks, not just for a one-shot time, but for all the other intervening forward rate periods that happen. And the payoff to this, to a caplet, to each caplet is, well, it looks exactly, like we saw earlier on a plain old interest rate call. It's L minus, it's the notional value times the maximum of 0, or the LIBOR rate minus the strike, adjusted for the time period involved. Okay? Now, the same thing applies if you flip this over and you can look at interest rate floors. And an interest rate floor is a series, of put options that cover these forward rate periods. And so the notional value looks just like a put option we saw before. And there's the payoff. Okay. And so that's what a floor is. A floor is a series of put options, and those individual put options are called floorlets. So now an interest rate cap allows, when you enter that, it allows you to ensure against rising interest rates, because remember, the payoff goes up with rising interest rates, right? So if you borrow, so if you're borrowing and you're borrowing at a floating rate for an extended period of time, then when interest rates rise, you're at risk. Well, look, the call option is going to pay off when you're at risk there. So you would use an interest rate cap to literally cap your interest rate payments. And that makes sense in terms of hedging a floating rate borrowing, where you obtain a loan, you borrow money, and you're exposed to higher interest rates. Now, with a little imagination, you can realize that interest rate floors put a floor on the interest rate that you can earn from a floating rate loan that you extend. So you extend a loan, where are your risks? Well, if you extend a floating rate loan, when interest rates go down, your loan is going to start losing money, but when you have the put here, the floor, it's going to cause it's going to give you a gain, a payoff, positive payoff that offsets that loss. So what it does is it puts a floor on the interest rate that you're going to receive on a floating basis. So let's cover an example. Let's examine a 3-month LIBOR caplet. In other words, an interest rate call that expires in 120 days. That's 4 months. Suppose an investor enters into a caplet at time 0. The computation of the payoff will be based on 3-month LIBOR that becomes known at t equals 4 months, which is the interest rate on a 3-month Eurodollar deposit starting in period 4, month 4, and maturing in 7 months. The caplet, however, will not settle at the option's expiration at T4. Rather, the payoff is actually made at T7 months. Okay? So, the timeline here for this example is, here's the forward period that the forward rate covers. And so we have a forward rate associated with that. So that the option expires here, so you enter in the option at time 0, the option expires here, and the payoff occurs at the end of period 7, okay? At the end of that deposit period. Now, as another example, the treasurer of a company expects to borrow at a variable rate in the near future, 60 days from now, and wants to hedge your interest rate costs using an interest rate call option. Okay? In other words, the interest expense. The treasurer expects to pay 4% for the debt, but obviously it could be higher in 60 days. The notional value on the loan is $5 million, and the loan covers 90 days. The loan covers 90 days. Now, a $5 million notional value interest rate call option is available with a strike of 4% that expires in 60 days. If rates turn out to be 5%, in 60 days, what will be the payoff on the option? Okay, so here you're looking at a timeline 0, here's 60 days or 2 months, and it covers a 90-day period, so this is 150 days, right? So this is the loan that's expected to be made covers this time frame right here. The borrowing of the money is in this time frame. It turns out that interest rates turn out to be 5%. Okay, so they were higher, and that was the risk associated with borrowing the money here. Interest rates go up. So what's the payoff? Well, it's $5 million minus the interest rate differential of 1%, adjusted for the 90-day period. This is a 90-day period. And we come up with a payoff of $12,500 right at this point. One more example, and this is not, this is basically driving off the previous one, except you got to flip your mind around here. A treasurer of a company expects to lend at a variable rate in the near future, 60 days from now, and wants to hedge her interest rate income using an interest rate put option. The treasurer expects to lend at 4%, but obviously it could be lower in 60 days. The notional value is $5 million, covers 90 days, and a put has a strike. There's a put available for this type of situation. with a strike of 4%. Okay, so here we got 60, here we got 150. The period here is 90 days, and this payoff of this option is 0.04 minus the 0.02, because in this example, rates turn out to be 2%. So it's a put, and you get that 4% is what you're going to receive. You're essentially giving up the 2%, adjust it for the number of days, and you get $25,000. $25,000 payoff right here for the option that expired right at 60 days. So notice, by the way, the floor that is involved with this transaction. You're getting 4% from the strike on the put. You're paying 2% basically with the negative sign here in the payoff. You're paying 2%, but you're getting 2% on the loan. So you can see that the end result is 4%. So we locked in, we put in a floor of 4% associated with the loan that was extended plus the put option, puts a floor of 4% on the income that we're going to get. Now, if we back up to the call example that we were looking at earlier, what we see is, look, this was a borrowing, remember, and you're subject to rising interest rates. So here with the option, we are collecting 5%. We're paying a strike of 5. We're collecting 5%. We're paying a strike of 4%. And then what we have is we're going to be paying 5% is what we're going to be paying in terms of actual borrowing costs. So what happens is we're getting the 5%. We're paying the 5%. Ultimately, we cap our costs with a negative sign in front of it from the borrowing. Our interest rates are capped at paying 4% for this loan. Now let's move into an application using interest rate calls and puts. Rather than doing a number of repetitive calculations, kind of like what we did with swaps, let's move into a more analytical problem. Suppose that you plan to borrow $1 million starting 1 year from now, and you plan to borrow it for 1 year. So timeline, 1 year, 12 months, and you plan to borrow for 12 months. This is your borrowing horizon. So we're going to need a forward rate. Okay, so you examine the LIBOR yield curve and see that this forward rate is 4%. Okay, that's the rate you expect to borrow 12 months from now for 12 months. Okay. You buy a caplet, in other words, an interest rate call with a notional value of $1 million and a strike of 4%. X is 4%. And you write a put with a notional value of $1 million with a strike of 4%. Compute your borrowing costs. So when we're going to compute our borrowing costs, we're going to compute our borrowing costs relative to 4%. Why 4%? Because that's the rate that's expected. That's the rate that comes off the yield curve in terms of a forward rate. So what we want to do is let's try to come up with a generic solution, and a solution in a format that you're used to. So we're going to look at what happens when LIBOR is less than 4%. What happens when LIBOR equals 4%? And then what happens when LIBOR is greater than 5%? Excuse me, 4%. And we're going to look at the borrowing costs. And the borrowing costs, and we're going to be general about this. We're going to label LIBOR as L, as I'm doing here. We're going to be specifically tying it to the 4%, but when we're looking at possibilities of where LIBOR could be, we'll just label it L, like we're used to doing. We've done this in previous chapters. So our borrowing costs are going to be 4 minus L, 4 minus L, and then 4 minus L. Regardless of what happens, our borrowing costs So we're borrowing at LIBOR, so we're paying the LIBOR, that's what the minus L is, but we're doing it relative to 4%. So in this case right here, when L is less than 4%, your borrowing costs are actually positive in a sense. Now I should be careful here, we should be careful. The borrowing costs relative to 4% are on the positive side, meaning, you know, it didn't cost us 4%, it's going to cost us a little less, so we kind of gain relative to 4% is what that's saying. Okay, and then what we're going to do is we're going to look at the call payoffs, and we're going to look at the put payoffs. And so this is a long call, and this is a short, in other words, written put. And so when you have call options with a strike of 4 here, you know when you're long a call option and rates go down, or just like, you know, when we covered stocks and stocks go down, the payoff is 0. When you're at the money, the payoff is 0. And when you're in the money, it's going to be L minus 4, because you're going to get L, positive sign, and you're going to pay the strike of 4. Now with a written put, you know, let's do the easy part first. Puts are out of the money when the interest rate goes up, but when interest rates go down, a normal put now here for a second here, a long put would be 4 minus L, right? Because that's what you're going to receive, and that's what you're going to pay, and that's the right. That's what you're going to end up paying. But since we wrote the put, there's a negative sign in front of it. Okay, so that's the payoffs that we're used to seeing. And so the net effect here is, look, everything cancels out. The L's and the 4's cancel out. This is actually 0 to begin with because L is 4. 4 minus 4 is 0. And we get a 0 for the net. And here, when LIBOR is greater than 4%, the payoff overall is 0. So what we're saying is your costs relative to 4% are 0. So graphically, we have the situation looking like this. Now, let's see if I can get different colors in here. Now the call looks like this. That's the call. And then a written put, I'll do it in green here. The written put looks like this. Okay? And so that's the combination of effects of a purchased call, long call, and a short put. And then we have the actual borrowing costs, which I'll put in blue here. There we go. And I'll put this in blue. There's the borrowing costs alone. And so the net effect is no matter what happens, interest rates go up, down, or stay at 4%, your payoff is 0. And so what we've done is we've done the narrowest of possible collars out there. We've collared LIBOR so that we don't gain or lose relative to 4%, which is what we expected to pay. So that's what you do when you eliminate risk. So, you know, you expect something, but it could be uncertain. But in this case, we've locked it in to 4%. Now let's look at another type of collar, you know, slightly more flexible. So let's say we have a collar here. So we're going to use we're going to create a collar with a lower bound of 3%, sorry, and a upper bound of 5%. Okay, and so let's see how this boundary works and how it affects our costs. So we're carrying the same example over, and we're going to, but we have different strikes. So we're going to have a put with an x equal to 3, and we're going to have the call with an x equal to 5. And we're going to short the put, and we're going to go along the call just like we did in the previous example. So we're going to have now, we're going to run scenarios of what happens when LIBOR is less than 3%, the lower bound. What happens when L equals 4%? Percent signs here. And what happens if L is greater than 5%? We're going to now look at the borrowing costs relative to 4%. Okay, relative to 4%. So that's 4 minus L, 4 minus L, and 4 minus L. So if LIBOR actually goes to 0 here, we're going to pay 4%. So everything's relative to the 4%. Okay, now we're going to look at the call. Okay, and with the call, we have a strike at 5%. So the payoff is 0, the payoff is 0, and the payoff here is L minus 5. Okay, and we're going to have the put. We're going to have a put with, just do the easy part, the put is going to have no payoffs when interest rates go up, but when interest rates go down, it's going to be negative 3 minus 4, or L, sorry, 3 minus L. So the net effect, net cost relative to 4% is plus 1, okay, because the L's cancel, and we get 4 minus 3 is 1. Here we get 0 because L is 4, so this equals 0. And here we get minus 1%. So what does that look like? Well, this is what happened. You get this. Okay, so there we have our basic setup. Let's do the long call in blue here. The long call is a payoff that kinks at 5. And here's the long call. That's in blue. Let's do the short put in green. And there's the put in green. We have a, running out of colors here. Well, put it in black. We have the borrowing costs, which are at 4%, relative to 4%. And so the borrowing costs look something like this. Borrowing costs alone without any options. Okay, now, when we net all this together, what we end up doing, and I'm running out of colors, but that's okay. I'll use blue, and I'll just do it heavy. What we have here is, if we're below, notice that the negative sign on that slope and positive sign cancel each other perfectly, but we end up with a 1% net gain here. And no matter what happens to L, and so that's the benefit of doing this generically, no matter what happens to L, we are going to gain 1% when rates go below 3%. And if you look at what happens when rates go above 5%, and they don't quite have this drawn, the scale, this side, this distance here, this distance right here should equal this distance, but I'm a little off. So this is minus 1. So no matter what happens above 5%, we're going to lose, we're going to pay more than the 4. We're going to basically pay 5% because we're going to pay the 4% and then a 1% more. Okay? And so we have this collar between 3 and 5 with the options, but what we end up doing is we collar our costs so that the net effect is we can benefit net by 1%, we can lose by 1% relative to the 4% expected cost from the forward rate. And then what we have is in between the 3 and the 5, this is downward sloping. So let me make this a little thicker here. This is downward sloping component. And then at the 4%, we break even, as you can see. And if we were to have something between 3 and 4%, you'd see that we'd be gaining a bit. And if you go between the 4 and the 5%, we'd be losing a little bit until we hit the floor. So we have a ceiling and a floor, and so we've collared. So here's the collar effectively based on having different strikes. Now in these two examples we've just looked at with collars, we looked at symmetrical collars around 4%. And that was because they're relatively simple. Now, to show you, now we've excluded from the analysis the premiums. We just looked at payoffs. But obviously, if you're looking into this, you would want to look at what are the premium costs. And there's some situations where people want to put on what's called a zero-cost collar. A zero-cost collar is where you collar the interest rates, in this case, interest rates, and you do it in such a way that the premiums from the call that you purchased is completely offset by the premium on the put that you collected because you wrote the put. Now, if you recall, call premiums are usually on the same strike. Call premiums are a bit more expensive than put premiums. So, in order to get a zero-cost collar, you're going to need to maneuver around and come up with, a call with a slightly higher strike relative to the put. So it won't be quite symmetrical, but you'll have a zero-cost collar. Now, why would you want to do a zero-cost collar? Well, that's basically you're developing insurance. You're creating insurance for yourself that has no cost because the costs offset. That's the benefit here. If you're developing these strategies and you need to present them to senior management or to a board, they're going to want to know what the costs are. And if you tell them it's a zero cost, and then you tell them, well, you've just locked in rates so they can't, and your returns are locked in, well, that sounds pretty attractive. And so that is the benefit here. You basically get a form of insurance. It's not perfect insurance because no matter what you do, you're going to have to pay something. And here it's relative to 4% in these two examples. But a zero-cost collar is an interesting way to go. So now what we want to move into is swaptions, which are options on swaps. We'll look at plain vanilla interest rate swaptions. So we'll look at the basic ones. A swaption can be European or American. There's going to be a premium associated with them. And so you're going to have we can have two types of swaptions. You can have a payer swaption, or you can have what's called a receiver swaption. Okay, a payer swaption, when you see the word payer in front of the word swaption, it means you pay fixed. And if you pay fixed, it means you're going to receive floating. So what I'm saying is, look, you have an option, timeline. You have an option starting at time 0. The option, which is called a swaption, lasts over this horizon, and then you flip into a swap that covers this a second horizon. So this could be 6 months, right? 6-month horizon before before this swaption, this option on the swap, is exercised before it expires. And when it expires, if it expires in the money, you flip into this swap. Okay, so you're going to have a payer swap where you flip into a pay fixed swap and you receive floating. You can also buy a receiver swaption, which allows you in 6 months to flip into a receive fixed swap. As you can see then, that a payer swaption is designed to hedge higher interest rate costs. So you want to avoid higher interest rate costs. And the way that would work is if at expiration, the time that the swaption expires and interest rates are higher at that point than your exercise price, in other words, your exercise rate, then you would enter into the swap to pay that low fixed rate at that point. Now with the receiver swap, you would be worried about interest rates falling, and so you would be wanting to lock in the future a higher fixed rate in which you want to receive. And so there you have it. There you have the basic motivation for it. Let's do it. So as an example, to hit this home, suppose you are the treasurer of a corporation and are unsure as to whether you will need to borrow money for a project that starts 6 months from now and lasts 5 years. Okay? If the project is accepted by the board of directors 6 months from now, the project, the bond will be issued. Okay, so you're at the mercy of the board and whether or not they're going to accept the project 6 months from now. And if they accept the project 6 months from now, you're going to have to borrow money to pay for this project. Okay, okay. The yield curve now indicates that 6 months from now, okay, 5-year forward rates are 4%, which indicates interest rates on the bond should be about 4% if we issue the bond 6 months from now. Since you don't know whether the project will be undertaken 6 months from now, you don't want to commit. You don't want to commit and lock in into a commitment when you don't really know if you're going to need the money in the first place. So that's where options come in. Options come into play is you can exercise or not exercise. So you're not committed. You always have the right but not the obligation. Okay? So in this case, we'll enter into a 4% payer swaption with a 6-month maturity. So again, basically, we start off at time 0. T equals 6, right? Is when this is the life of the swaption, and then we're going to enter into a swap into a swap, plain vanilla interest rate swap. Okay, that is going to pay 4%. You're going to pay 4%. Okay. Now, so you enter into a 4% swaption with a 6-month maturity. 6 months later, T equals 6. Interest rates on 5-year bonds is 7%. So right at this, for this 5-year period here, interest rates are now 7%. They were 4%. Okay. And so if you look at it, at this point, swap fixed rates will be 7%. Okay. Since your R, since the current R is greater than the 4%. In other words, the current R, which is 7%, is greater than the 4, your exercise price. Okay, it's your swaption is in the money, and so you exercise the option. You flip into a swap where you pay 4%. So now the treasurer has a 5-year swap that requires a 4% fixed payment every 6 months in return for LIBOR, which, as we know, at times T equals 6, is expected to average. So LIBOR is expected to average 7%. I mean, that's how basically the R is derived. Okay? Assume the treasurer issues the bond at 7%. So the treasurer not only flips into the swap, but issues the bond. Okay? Because they need to finance the project. Each period starting with the first swap payoff, which the first swap payoff will happen at T equals 12, 6 months from now, and they'll have 6-month payments for the next 5 years. Okay, what will happen is each period starting with the first swap payoff at T equals 12, the treasurer will pay 4% on the bonds and receives LIBOR. The treasurer pays 4% on the swap and receives LIBOR. Okay, so that's the swap part. It pays 4% and receives LIBOR, which is expected to be on average 7% over the life of this swap. Now, thus, what will happen is you'll pay 7% on the bond, you'll get LIBOR, and you'll pay 4% on the swap for a net of 4. Okay, payment of 4. That's your cost. And what that means is you've just locked in 4%. Now, had the 5-year rates gone down, the swaption would have expired worthless, and the treasurer could have issued the bonds at a lower rate. So the scenario I covered here is if interest rates go up, and then the swaption becomes valuable, and you exercise into the swap. But don't forget, if interest rates go down, you've paid a premium to ensure this, but you didn't really need it, and so when you issue the bonds, the actual bonds interest rates are lower. So there's a trade-off. You paid a premium to get a lower rate, or if rates go lower, well, you paid a premium to try to insure yourself. So with that, I conclude Chapter 12 on interest rate forwards and interest rate options. So we covered forward rate agreements, interest rate options in general, caps, which are a series of caplets, which are a series of call options on interest rates. We looked at floors and floorlets, which are on interest rates. And then we looked at payer swaptions, receiver swaptions, and boy, by the time you get done, your head's spinning on this. And so now it's a good time to conclude this chapter and the course.